Nuestro primer conferencista, y como todos ustedes lo saben, es John Mack. John Mack llegó a Morgan Stanley en 1972, cuando esta institución funcionaba todavía como un partnership y tenía únicamente 350 empleados. Actualmente tiene más de 63,000. Fue electo presidente del Consejo y CEO de Morgan Stanley en junio del 2005 y hasta enero del 2010, cuando abandonó el cargo de CEO para actualmente quedar como chairman. Antes de su cargo actual, se desempeñó como presidente del Pequot Capital Management, co-CEO de Credit Suisse Group y CEO de Credit Suisse First Boston. John Mack se graduó de Duke University, donde actualmente es miembro del Consejo de la Universidad. También es miembro del Consejo de diferentes asociaciones como el New York Presbyterian Hospital, University Hospital de Columbia y Cornell y Doris Duke Charitable Foundation. Será de sumo interés lo que John Mack, el presidente de uno de los principales bancos de Estados Unidos y sin duda uno de los banqueros más respetados del mundo, nos pueda compartir esta mañana. John, it's really an honor to have you with us today. Thank you very much for coming.
Well, it's an honor to be here. As some of you know, my son lives in Oaxaca, so I'm very close to Mexico and spend a fair amount of time here. I want to clear up just a couple things. Chairman of New York Presbyterian Hospital, we have 2,000 rooms. It's almost a hotel. So hopefully none of you need anything from our hotel hospital, but if you do, please let me know. I can help you. You know, there are a number of topics that I could talk about, but the questions that I get most often, no matter where I travel, and last week I was in China, is about the financial crisis and what happened during the financial crisis. So what I'd like to do is take you through that week where Lehman Brothers went bankrupt, where Merrill Lynch was bought by Bank of America, and when everyone was looking at Wall Street as a possibility of collapsing. And as some of you may know, there was a book written, Too Big to Fail, and that was the week that everyone thought it was too big to fail. And then I'd like to talk briefly about some of the emerging markets and where I've been, and after that we could do some Q&A if you have some questions you'd like to ask me. Well, we knew in 2007, in the fourth quarter, that the markets were beginning to change. And in Morgan Stanley, we were running, like many of the firms, big balance sheets, big leverage. I want to say our leverage was probably, on average, in 2007, around 32 times leverage, which is not dissimilar to all the other firms. Some were larger, some were smaller. But in the fourth quarter of 2007, it became apparent that the market was getting toppy, especially in the mortgage and subprime area. So we began then to deleverage. By the time the Bear Stearns situation occurred, which was probably in late March, early April, we had deleveraged to the point we were around 22 times leverage. And as you know, the government worked out a transaction, really Hank Paulson, with J.P. Morgan that would acquire Bear Stearns. From that moment on, we tried to accelerate, as did other firms on Wall Street, either deleveraging or alternative sources of capital. So in the end of 2007, going into 2008, Morgan Stanley approached the CIC Sovereign Wealth Fund in China, and they made a $5 billion equity investment in Morgan Stanley. So we were preparing for what we thought was going to be a very difficult time, but had no idea how bad it was going to be. So now let's move forward through the summer, and it's the first week or two of September. It's a Friday afternoon, and I get a call from Hank Paulson. Secretary Paulson says, John, we're going to have a meeting at the Federal Reserve in downtown New York. You need to be there by 6 o'clock, and you can bring one other person. So I asked my CFO to join me. I don't know how familiar you are with New York, but I think you're probably very familiar. Traffic not as bad as Mexico City, but sometimes it is. We got on the west side, on the Hudson River side. It was raining, traffic was not moving. So my driver, who's an ex-policeman, he looked at me and he said, "Boss, you see where all the bicycles are on the bicycle path?" I said, "Yes." He said, "Does it go all the way downtown?" I said, "Yes." So being very aggressive, he turned, got on the bicycle path. We went down. We were there in 5 minutes. Of course, many of the bikers were upset. We have scratches on the car where they hit us as we went by. We go to the Federal Reserve. All the major firms are there. Hank Paulson, Chairman Bernanke, Tim Geithner, and the head of the SEC, Chris Cox. What Hank Paulson said, he needed Wall Street to come up with between $12 and $15 billion that he could use to keep Lehman Brothers in business. Of course, all of us started questioning him, saying, "You're asking us to keep a competitor in business. We don't quite understand. If you're that worried about Lehman Brothers, you should give them some backstop, some guarantee, as you've given money to Fannie Mae, as you've helped AIG." His answer was, politically, he did not have the power to go back to the Congress for a bailout. But if we could come up with the money, it would help him going forward if others would need capital infusion. So after hours of back and forth and arguing back and forth, one of the CEOs, it may have been Vikram Pandit at Citibank, said, "Hank, if we do this, what are we going to do the next time another firm gets in trouble? Are you going to come back to us? Are you going to ask us to bail them out?" And Hank was very clear. If you help me with Lehman, and I can show the politicians that Wall Street is being helpful, I'm confident that if there is another problem, I will get federal help. Another CEO asked the question, "Well, Hank, to be very direct with you, as soon as Lehman is done, the next company is Merrill Lynch, and then it's Morgan Stanley, and then it's Goldman Sachs. How are you going to stop this kind of contagion?" And Hank again said that he felt if we could help Lehman, he could get the government, if there was turmoil in the markets, to stabilize the markets. So we left Friday night. We all went back to our offices late. We planned for an early morning on Saturday. We broke into different groups. I think Morgan Stanley and Citibank looked at a lot of the balance sheet and positions of Lehman Brothers. I think Credit Suisse and Goldman Sachs looked specifically at their mortgage issues and what they had on their books. And then the other banks looked at some of their other positions on how we would end up taking on some of their risk. At about 11:30, we were called back into the conference room, and he said, the transaction we were trying to do, and what he was trying to do, was to merge Lehman Brothers and Bank of America, and he wanted $12 billion for us to create a good bank and a bad bank. So Secretary Paulson says Bank of America is no longer interested in doing an acquisition of Lehman. Now Barclays is looking at an acquisition of Lehman. So after that meeting, it was apparent to me that the next firm under pressure would be Merrill Lynch. And I saw Secretary Paulson and Tim Geithner, who was then head of the New York Fed, take John Thane, the head of Merrill Lynch, into a room, and I think convinced him he had to sell his firm. When he walked out of that room, I approached John and said to him, "Look, you and I should sit down and talk. Maybe there's a transaction that we can do together." And late Saturday night, we met at 9 o'clock at night at one of my president's apartments. There were 3 people from Merrill Lynch, there were 3 people from Morgan Stanley, and we talked about putting the 2 firms together to create a very strong balance sheet. As we talked for a few hours, John said to me, you know, do you think this makes sense? And I said, yes, there's a lot of synergies, a lot of power if we could put the two firms together. And he said, well, can we announce a merger? I said, John, are you crazy? We just met for 3 hours. We're going to announce we're doing a merger. You haven't talked to your board. We haven't done any due diligence. I haven't spoken to my board. So I knew then either John was trying to negotiate to be in a stronger position with another bank, or he was clearly desperate to do a transaction. And we turned that down, and the meeting was over. The next day, we go back to the Federal Reserve. This is Sunday. We told Hank Paulson we've come up with $10 billion that we could put into the Lehman transaction with Barclays. And he then said to us, well, we have some very bad news. Barclays has pulled back. The FSA and the Central Bank of London will not allow them to go forward without an equity vote of shareholders. So then the decision was made. Lehman Brothers was going to go bankrupt. Later that night, we learned that Merrill Lynch and Bank of America were going to merge. So Monday morning, Morgan Stanley and Goldman Sachs knew that we'd be under attack. And clearly, with a smaller equity base than Goldman Sachs, we would be first and they would be second. Lloyd Blankfein and I talked 3 or 4 times a day, and it was all about survival. How can we stay in business? So, since you're all investors, let me just tell you how pressure was put on both ourselves, Goldman, and Morgan Stanley, but also eventually General Electric and other financial institutions. At 2:45 in the afternoon, you would see the Morgan Stanley shares start to go down. You would see our credit derivative swaps, CDS, the spread would widen out. At 3 o'clock, the Federal Reserve closes the window where we can post collateral for cash. And your customers, your clients, are now taking their credit balances and their margin balances out of your firm. At 10 minutes after 3, you would get a call from Credit Suisse or JP Morgan or one of the banks saying your stock is going down, your credit spreads are getting weak, there's got to be a problem, you need to post $10 billion or $5 billion in collateral if you want us to clear for you. That was the essence of the attack on the banks. Now, I got a lot of criticism from the hedge fund community because I was vocal about short selling. Everyone agreed with me over the weekend that short selling in a time of crisis on financial stocks was not a good thing. The one exception was Lloyd Blankfein. By Tuesday, Lloyd called me and said, you're right, we need to put pressure on the SEC that we can no longer have short sellings until the crisis calms down. I'm a big believer in short selling. It creates liquidity. It's a way that a portfolio manager can express their opinion about a company. And I believe it creates a lot of good analysis on companies. But in a time of crisis, and I think a crisis where the SEC did not fully understand the impact of derivatives on a short sale. So again, I was very vocal. I got a lot of criticism. But I got to be honest with you. I thought it was the right thing to do. And eventually the SEC, as you know, did put a stop on short selling for a period of time. On Monday, when we came to work at Morgan Stanley, we had created $161 billion in cash. In the first 2 days, almost half of that was taken out of our bank. The stock dropped from the mid-30s into the teens and fluctuated back and forth. On Tuesday, now this is 2 days after Lehman went bankrupt, Goldman Sachs announced their earnings of a 7.6% return on equity. We were to announce on Wednesday, the next day. I made the decision that we would do it Tuesday at the close, and we announced that our earnings were 16.3% earnings. They were very strong earnings. We go home, we come in Wednesday, the market opens up, Morgan Stanley's stock is down 25%. Goldman stock's also down. So now we're in a contest to figure out where do we get funding to shore up our balance sheet and give investors confidence that this firm will be in business along with Goldman Sachs. I made a lot of calls. I called the Chinese, we called the Japanese, I called Warren Buffett. While I was doing that, Goldman Sachs was calling the same people. We were all trying to figure out how we can stabilize these markets. During all of this, the Federal Reserve, Tim Geithner, was constantly putting pressure that we should think about selling the firm. When we announced our earnings, which were very strong, I got a very good call from Vikram Pandit congratulating us on our earnings. I got a call from his chairman congratulating us and saying that they would love to merge with Morgan Stanley. And I got a call from J.P. Morgan, from Jamie Dimon, who also was very complimentary. So as our stock continued to drop, we made a decision that we should have a conversation with Citibank since they had asked about merging. I called Vikram on Wednesday afternoon. He said, "John, we'd love to do it. I have to go to my board." 4 hours later, he comes back and says they're not willing to do it given all the turmoil. I called Jamie Dimon. This was under the urging of Tim Geithner at the Federal Reserve. And Jamie said, "John, I don't want to buy your bank. I just bought Bear Stearns. I don't know why Tim Geithner told you that. I don't want to buy it." So we all go back. On Wednesday, my CFO comes into my office, and he says, "John, we're going to be out of money on Friday." I said, "Cullum, that's impossible. No, we're going to be out of money." And I said, "Well, look, you go to the financing desk. Follow the transactions. I know we can't be out of money." He gets up and leaves. I shut the door. I take 10 of the deepest breaths I've ever had to take. And later, 4 or 3 hours later, he comes back and he said, "No, you're right. We have to put money into the clearing system. $60 billion will be coming back in the next 2 days. We have money for another week." So that was the pressure and the stress not only Morgan Stanley was under, but Goldman. And clearly, as Lloyd said to me, Lloyd Blankfein, he said, "If you go down, I'm 20 seconds behind you." Because all the attention then goes to the next bank. And if you remember in this time, in the week after, General Electric stock traded at $5.70 based on the same selling of the equity, buying CDS, and putting pressure on, really the pressure is on confidence and trust. So if you're a manufacturer, if I'm Caterpillar or I'm John Deere making tractors and bulldozers and earth-moving equipment, you do business not based so much on trust, it's on products. But in the financial system, if you lose confidence and you lose trust, you're going to go out of business. For those of you who manage money, you've all read, a hedge fund gets in trouble. Read about the investigations that are going on now in New York, Boston, and other areas on insider trading. Immediately, investors start taking their money out of the hedge funds. The valuations drop, the market goes down. So trust is the most important ingredient in financial service, and that's what was being attacked. Under a number of conversations with Hank Paulson, and just to be clear, if there's one hero in the financial crisis, it's Hank Paulson. What he knew about the markets and about Wall Street and about the banking system had tremendous impact in his ability to get things done and to understand what the problems were. Tim Geithner at the New York Fed clearly was doing his job, but constantly put pressure on me to sell the company. On Thursday, my president, James Gorman, who's now the CEO, my CFO came to see me. They said, we got a call from Jamie Dimon at J.P. Morgan. He wanted to know what could he do to help, what's going on. He said, John, he wouldn't call us unless he wanted to do a merger. Also, Tim Geithner's telling me, call J.P. Morgan. So in talking to my president and CFO, talking to Tim Geithner at the New York Fed, I called Jamie. He says, John, I don't want to buy your bank. If I did, it'd be for $1 a share. And I said, well, thank you, that makes no sense. He said, I have no interest. I said, well, if you have no interest, don't call my president and call my CFO. If you want information, you call me. Now, Jamie's a friend of mine. He's very smart. To his credit, all he was doing was getting information. By Friday, we've had the Chinese in for 3 days negotiating on putting a huge capital injection into Morgan Stanley. And I'm very fond of the Chinese. I'm actually on their advisory board at CIC. A year earlier, when CIC put $5 billion in Morgan Stanley, we didn't need the money in a desperate way. We wanted the money over time. So when they came to New York, they sat on one side of the room, we sat on one side of the room, and over the course of 3 days, we negotiated, got closer, and then we did a deal. And I remember walking out with Gao Xixing, and he said to me, that was a lot of fun. I didn't think it was a lot of fun, but it was a lot of fun. So during the crisis, they wanted to do the same thing. The problem is I didn't have the time. I needed to get a deal done. So I ruffled some feathers with the Chinese. In the interim, I get a call from our Tokyo office that says that Mitsubishi, which is the second largest deposit base in the world, has interest in doing a major capital infusion into Morgan Stanley. They will talk to you Sunday morning, 6 o'clock in the morning Tokyo time, 5 o'clock in the afternoon New York time. I had to call my board of directors into the office because we were on very thin ice. And clearly, and some of you are directors of companies, you know, when a company's in trouble, the responsibility of the board increases dramatically. And I really felt for the board. They were kind of looking in without the ability to take action. The board was very nervous. So nervous that they had hired outside lawyers, an outside investment bank, a small boutique bank, to represent them if we were going to go bankrupt. So we meet Saturday. We're still calling people in the Middle East. We're calling people all over the world. We can get capital infusion and stabilize the trust that we needed to stay in business. Also during that time, the rumors on not just Morgan Stanley, on Goldman Sachs, on General Electric were constant, and they were rumors. There were no truth to it. But in the day of the internet and the blog, you can almost put any rumor out there. So we get to Sunday. We have all of our executive team in. The board comes in at 1 o'clock in the afternoon. We have a board meeting. We give them an update. And then we have nothing to do. We have to wait until 5 o'clock in the afternoon. So there are 15 people in my office, and we turn on the television and we watch the football game. At least we could relax a little bit. My secretary walks in and says, John, Hank Paulson is on the phone. He wants to talk to you. Well, I'd spoken to Hank on Saturday, and for the first time, Hank had changed his opinion and his views. He was telling me, you have to do something, and if you cannot do it, you should sell your company. And that was a tough conversation because Hank Paulson had been the biggest supporter of the banks and of the investment banks. And now for the first time, he was changing his view. So my biggest ally has now moved on the other side. He and I got in a little bit of an argument. I told him, well, the Japanese are going to invest with us. He said, come on, John. You and I know they will never make that decision that fast. I said, no, I don't know that. I know that we did a hostile takeover for them. That's not typical the way a Japanese company would operate. I believe they will invest. So we disagreed, hung up the phone, and from my perspective, that was the second really difficult conversation. The first, as I said, was my CFO when he told me we'd be out of money in 3 days. But that really shook me because I knew now I had no support out of Washington. So my secretary walks in, we're watching the football game, says, Hank Paulson wants to talk to you. For some reason, I got up from my desk, I went over to my sofa where some people were sitting, and I picked up the phone, and Hank said, John, I'm on the phone with Ben Bernanke and Tim Geithner. We want to talk to you. I knew that was not a good phone call. And I said to Secretary Paulson, I would like to have my general counsel on the phone. So I pushed the speaker button. The general counsel was in the room with the rest of us, so everyone could hear the conversation. My gut reaction, my instinct, was to tell them before they said a word, I'm not going to sell this company. But experience really helps you do things right. So I calmed myself down and I listened to them. Hank Paulson said, John, you don't see the globe, the world, what we see that's going on. We're worried the entire system, not just in the United States, can crash. We need to find a solution for Morgan Stanley. I listened, and Ben Bernanke said, John, if you could see the problems we're beginning to see in the financial system, in the clearing system, the breaking in confidence, we cannot open the markets on Monday unless we have a solution for Morgan Stanley. And Tim Geithner, who I talked to all week, got on the phone, and he said, John, I want you to call Jamie Dimon and sell your company. And I said, Tim, you've been telling me that all week. Number one, he doesn't want it. And number two, it doesn't make sense. He said, no, he wants it now. You call him. And it makes sense because we want financial stability. So in trying to keep myself calm, I needed to talk a little bit. So I said to Tim, I said, let me ask you, Tim, and your other two gentlemen, from a public policy point of view, New York has lost between 35 and 40,000 jobs in financial service. Lehman Brothers, AIG, Merrill Lynch, Bear Stearns, and all of us have begun to lay off people. Does this make public policy sense? Tim Geithner said it's not about public policy. It's about financial stability. Pick up the phone and call Jamie. So then I said to them, gentlemen, the three of you have my respect. What you've done for this country and the financial system, we will always be grateful. But I won't do it. I'll take the firm down. And I hung up on him. So we all look at each other, what have I done? But, you know, you can do analysis forever. But at some point, you have to go with what's here. You have to make the tough decision, and you have to suffer the consequences if there are consequences. I knew that was the wrong thing to do. An hour later, I'm on the phone to Tokyo. The door is shut. I have my head of investment banking behind me. I have his chief of staff on the other side of my computer, Jian Lee. And many of you know through translation, you talk into the phone, you wait for the translation, then you talk into the phone, you wait. It's very difficult to keep your concentration, so you have to stop your sentence, wait 10 seconds, and start again. So the concentration to deliver your message takes a lot of focus. So 3 minutes into the phone call, I'm talking to the chairman and CEO. My secretary comes in. Tim Geithner's on the phone. He wants to talk to you. Well, tell Tim I'm on with the Japanese. I'll call him back. 2 or 3 minutes go by. I talk. I listen back and forth, back and forth. She comes in again. Hank Paulson's on the phone. He wants to talk to you. I said, tell Hank I'll call him back. I'm on the phone with the Japanese. 3 or 4 minutes go by. And what I want to tell you is verbatim, so this is what I said. She comes back in, and she's short, and she says, Tim Geithner's on the phone, and he wants to talk to you right now. You tell Tim Geithner to get fucked. I'm trying to save my company. I don't care about Tim Geithner. I don't care about Hank Paulson. I care about one thing, closing a deal with the Japanese. We meet with the Japanese. They call a board meeting later in that afternoon. They call back Monday night and say that we want to go forward with a $9 billion injection into Morgan Stanley. At the same time, I really believe by taking the strong stance that we did with the Federal Reserve and the Treasury, that's why Morgan Stanley, Goldman Sachs became a bank holding company. Once that was put in place, it was a message to the market that these firms are going to survive. So, I think back, also, just one little story. I went home that Sunday night, and my wife, Christy, had come into the city and was at the apartment. So I walked in, and I was upset. I said to her as I walked in, I said, I may lose the company. And I walked into my living room, and I just kind of walked around to get my composure back. And came back to her, and I said, but Christy, I would rather be doing this than reading a book in North Carolina. The adrenaline rush to get through this is like something I've never had in my life. I'm glad I did it once. I never want to do it again. And again, I want to compliment Hank Paulson. I can't imagine what would have happened on a global basis if we had not had Hank in that position to have such power and understanding. So I'll answer any questions, but let me just make a comment, if you don't mind, about emerging markets, because I spend a lot of time, whether it's in Mexico or whether it's in China or Brazil or India or Russia, it doesn't make any difference. There are a few places I haven't been, but I'm going to Nigeria, I think, in the beginning of the year. I have never been more bullish on the emerging markets. Are there problems? Absolutely. But when you think about where you can invest, where GDP growth is going to be somewhere between 5.5% and maybe 8.5%, 9%, when you visit these countries, which some of you have done, and you see what's going on in this country, what's going on in Brazil, what's happened in China. When I was in China last week, I went one day early because I never have time to sightsee or see anything. And my wife was in Washington on a healthcare conference. And I went one day early. I wanted to ride the bullet train. So I got on the train in Beijing to go to Tianjin. It's a 3-hour drive. I got to Tianjin in 35 minutes. You see the amount of infrastructure that's being put in place in these countries. And look, India has a huge problem in infrastructure, but the growth of that, it's going to be slower than China, but it's going to last a long time. So for you money managers, and I think some of you have global funds, If you haven't, I urge you to spend time in the emerging markets. I think most portfolios, especially in the United States, when I look at portfolios, I'm shocked how little money has been allocated on an asset allocation basis to the new markets. But that trend is beginning to change. And if you have questions about EM markets, I'll be happy to take them. So with that, if you bring the lights up, if you have any questions, I'm more than happy to answer them. And I can't see out there, so someone will have to pick you out. The lights have got me. In the very back, there's a question. I see a hand.
Hello, Mr. Mack. I have a question regarding the European markets. What is your view regarding the European banking system right now?
Well, I'm very cautious. I'll talk about my own portfolio. I told Botín 2 weeks ago when I was in Madrid, I own some Santander stock. I think some of the banks will come out of this very strong. I would be cautious, clearly, in the smaller banks. I'd be cautious in the UK. But I think there are great opportunities in some of these banks. It's a risky trade. But when have we seen prices like this? At the end of the day, you cannot have a financial recovery without a strong banking system. And I believe the governments, and you see it in the United States with Dodd-Frank, you see it with Basel III, you see it with the conversation G7 and G20, there's a lot of focus on the banks. I would be willing to take a risk on investing in the banks. You got to pick your spots, but I'd be an investor in them. Okay, well, I don't see any other questions. I know you have a full agenda. Roberto, I want to thank you again for inviting me. It's my pleasure to be here. It's also, I've met many of you in the past, and it was good to see you. Thank you very much.